Good morning. Joe Mass here. It's time for another market review. So let's take a look at the third quarter of 2025, kind of look at what happened, where we're at, and where we think we're going. So we'll start off with a review. We have a proprietary market cycle multi-factor model that we look at, and right now we are still about 75% bullish for the quarter, 25% bearish. This is also going to be the theme throughout the day is with the Fed getting ready to cut rates. That should bode well for the market. So again, right now, we still have a 75% bullish score, meaning the market should go up, where it's a favorable for risk on assets, and 25% bear score. When we look at the S&P 500 over the last quarter, it was a pretty strong quarter, up almost 8% from 61.98 to 66.88. And you can see that the market stayed above the three moving average lines. And so again, not a lot there other than the market had a strong quarter. When we look at supply and demand, we'll see in the red box that demand, the buyers stayed in advance ahead of the sellers. And so that again was welcomed by the market, and that's why we saw the market up. So again, remember when everything's based on supply and demand. So if the sellers are in favor, if they're the in vogue crowd, that's bad for the market. That's the red line. So the red line being down is good, and that black line being up, the buyers, that's what we want to see, and we saw that again for last quarter. When it comes to the sectors, technology led the way, followed by consumer discretionaries, communication services, and then the S&P 500. And then starting with utilities, utilities, energy, industrials, healthcare, financials, materials, real estate, and consumer staples were all below the general broad market of the S&P 500. And consumer staples was the only sector negative for the quarter at 2.55%. When we look at the asset classes, we can see that silvers and metals and golds that were acting like risk on assets last quarter, we highlighted that kind of in the middle of the pack. They've moved to the top of the pack. So again, a very strong quarter for those metals and small caps. And again, small caps start to do well as the market expects rates to come down and the Fed to cut rates. That can usually help the financing aspects of smaller companies. And so they usually do well when those rate cuts are announced and the market starts to run there. So again, very strong quarter across the board. International bonds were at the bottom there at just about a 0.5% return. When we look at the S&P 500, we had a lot of breadth, 317 companies up, 194 companies down. Again, on the left in the green, that you'll see the interesting thing there is you don't see a lot of those FANG stocks or the Meg 7s, right? We had a little more broad participation. You do see Alphabet there, and there are some of the usual names, but again, a little more breadth over the last quarter. And then you can see Trade Desk really was the bottom of the pack there at down 32%. So a good breadth, and we ended up with just about, again, 7.8% return on the S&P 500. So, is the market overvalued? Well, it kind of depends on your perspective. On the top graph, we see that the market cap weighted index, the S&P 500, is well above its average on its forward-looking PE ratio. Again, the forward-looking PE ratio is a crude measure of valuation. So right now, at the index level, it does appear to be overvalued. Again, we have to look down to each company within the index to see if each company is undervalued or overvalued. So again, as you're going to see, we still favor active management where we can go through each stock one by one and find the ones that appear to be undervalued so that we're not buying the general market at a high point. Now the story changes if you look at the equal weighted index down here, the equal weighted index on the S&P 500, it's about fairly valued. It's right at its average forward-looking PE. So again, the market cap, as we'll see, has been performing better, but there does appear to be a little bit more value in the equal weight if you're just buying the indexes. But again, we favor active management where we can go through the stocks one by one, look at each story, look at each narrative, look at each CEO and manager and business, and really analyze it from the bottom up. And that's how we manage our portfolios. So equity call volume is kind of an ugly word. So this is just a way to look at what the crowd might be doing. So calls are a bullish option. And so if there's more people buying calls, that's good. If there's less people buying calls, that's kind of bearish. And so you'll see that through the quarter, we had a couple of spikes, one here down below the average, one deviation point, and here's a spike up above. Here's a big spike, right? Some people got really excited about the market, but we really ended up about average. And if we look through the quarter, we're trading really about average, within that average range, and so that was good. And the market, as you saw, had a good quarter. So nothing too abnormal there, except for a couple spikes. But all in all, the call volume was within its range. Okay, the economy and recession. So we also run a proprietary model to determine whether we think we're getting close to a recession or not. Of course, nobody knows, but we try. And we're still pretty bullish. 75% bullish score means the economy is still doing pretty strong. But remember, if it gets too strong, if this was 100% bullish, that would start to give us some concern. So remember that with economics, sometimes good news is bad news and bad news is good news. And we'll continue this story. But our model did show a score of 75% bullish on the economy and 24, almost 25% bearish. So when we look at this cycle, right, if we were 100% bullish, we'd probably be up here at point C. And so that means we might want to be a little more concerned because the downfall might be coming, right? And if we were 100% bearish, we might be down here at the new low at F, and we might be a little more excited because there's an expansion coming. So we kind of believe that we're probably here just trying to skirt across the midpoint. We really didn't have a severe downturn. GDP is forecasted to grow approximately 2% for the next several years. So, you know, that's not too low, not too high. We can grow at 2% for a long time. And so we think that we might avoid the low here and just skirt across. Now, the Fed is reducing rates because there are some chinks in the armor, right? And so that's the confusing part, is that the Fed is lowering rates because the economy is cooling down, but the market is anticipating that and they're excited for the rate cut, so the market goes up. So again, there's some inverse relationships here. But all in all, we think the economy is relatively strong. It is showing some signs of weakness in labor and potentially some earnings and inflation, and we'll talk more about that later, but nothing is falling off a cliff yet. So it looks like we're trying to skirt across here and avoid a new severe low. Okay, so we don't know, of course, but that's kind of what the data is showing us, and we'll continue to watch that. When we look at one indicator of is a recession really coming, this is we like to look at the unemployment rate. And what we're looking at here, these red bars are recessions. The green line is the raw data of unemployment, so 4.3%, which is relatively low. And the blue line is the rate of change on the unemployment. And again, as you know from prior market updates, it's this blue line that we're concerned with. It's the blue line, the rate of change in the unemployment rate. And so as you'll see in the past, that when the unemployment rate goes down from, you know, a little bit below 0 above 1, we get a recession, and so forth and so forth. So if this unemployment rate spikes from a little bit below 0 up to 1, we would be a little more concerned that a recession was within our horizon. Okay, so nobody knows, but this is what the data is showing. And so we're not overly concerned with a recession at this time. So the economic indicators, right, that talk about a recession, there's 3 of them, right? There's the leading indicators in green, the coincident indicators in blue, and the lagging indicators in orange. You know, you guys are starting to get familiar with this chart. And as we see here, where are we going? That's the leading economic indicators. They have been down for quite some time. In the past, once they turn down, you see a negative or a red line. You see that negative there. That's a recession. We see that here. It turns down, we get a recession. And again, we see that back in the early 2000s. So right now they've turned down, but we haven't had a recession. And so that's interesting, right? It's been a long time with negative indicators, and we'll talk more about economic activity in the next slide. The coincident indicators, they're still positive. The lagging indicators are still positive. And what's interesting with the lagging indicators is that they don't turn negative until after the recession. Okay, so they're lagging. We don't expect those to be an indication, except that when it's passed. Okay, so that's the road. That's kind of the windshield of the car up there, the green line. The blue line is like looking out of that side window of your car. And then the orange line is looking at the rear view mirror. Of course, the road that got us there, that's the red cycle. That's the Fed rate cycle. And we can see that they started to lower rates again. Okay, and we'll talk more about that story. So there's where we're at, where the economic indicators. When we look at economic activity, we'll see that the blue and green lines on top, these are the forward-looking out the windshield concept of the ISM Manufacturing and Services Index. Anything above the red line is bullish, meaning the economy is expected to expand. Anything below this red dashed line, the economy is expected to contract. So you'll see that they're both hovering right around 50. Okay, so it's not really hot, not really cold. When we look backwards at the GDP numbers, we see positive quarters here, little dips, but predominantly it's been pretty strong GDP. They did revise it down here this year, so we have seen that revision down, but the forecasts are still to be about 2%. So nothing great, nothing bad. It's just we're right on that teetering point, right? That's why the data is really not very conclusive. And then down on this last panel, again, we have the orange line is the Fed, the white line is the market. The market, as you can see, is starting to go up as the Fed is talking, or as the market expects rates to come down. Okay, so if the rates continue to come down, the market will probably applaud that and continue to climb. And we'll talk more about the market in a moment. But there's what we have for economic activity. So when you sum it all up, this is a nice chart from Bloomberg. It's just from their consensus estimate. They have their contributors giving you a median probability of about 33% that there's a recession in the next 12 months. So again, not a horrible number. It was 35% last quarter, so it's hovering in those mid 30s, and we're still in a wait and see mode, but we don't see a strong probability over the next 12 months. Okay, what drives the market? We know that there's bull cycles and bear cycles, and we know that interest rates, inflation, corporate earnings, and the Fed are the main factors, with geopolitical events being the fourth factor. All right, and so right now we're still in a pretty bullish market, right? Our indicators are up, the market's up year to date, the market's up for the last several years. And so we're probably up here, right? If the market is still doing very well, it has a few inter-period pullbacks, but we'd have to say that we're more in a bullish market than we are in a bearish market. So when we look at the factors, inflation, the PCE, which is the Fed's favorite measure of inflation, is at 2.7. According to the University of Michigan, over the next 5 to 10 years, it's expected to go up a little bit to about 3.7. Okay, so still low, not quite as low as the Fed would like it, but not raging out of control. So that's good for the market. Interest rates on the 10-year bond yields fell during the quarter and ended around 4.1. They're kind of in a range. So again, with rates coming down, the bonds are anticipated maybe to fall a little bit. So that's also good for the market. Corporate earnings have been above average. They've been resilient. Uncertainty still remains, of course, as it always does with tariffs and other geopolitical events and single events for certain companies. But all in all, earnings have been okay in supporting the markets. The Fed began to cut rates, okay, and the markets and the Fed expect to be below 4% by year end. On the geopolitical front, tariffs, new tax bill, military conflicts, assassinations, right, very sad quarter. These things are all out there. They haven't been weighing on the market very much. As you saw, we had a strong quarter, so they still exist, but the market is looking past some of these geopolitical events currently and looking more at the fundamentals. Again, the inflation, interest rates, corporate earnings, and the Fed is really what's driving the market, at least over this last quarter. Here we can see that the current earnings are 261, estimated to be about 265. So there's a little bit of earnings growth from here, and we can see the blue bar shows you the range of those earnings estimates. So again, the earnings are still resilient, and they will ebb and flow, but they are still being resilient. There's some talk that earnings might only be announced twice a year instead of 4 times a year. I support that. It's not a political statement. It is a fundamental statement. When we buy a private company, we're not looking at its earnings every quarter and revaluing it. We're looking at 3, 5, 10 years. So as we hold these companies, we're not buying them. We're not renting stock. So again, we're not buying them for a short period of time. We're buying these for the long term. And so, companies putting out their earnings twice a year, I think saves a lot of money. I think that would bode well for people. So we'll see if that happens or not, but I don't think that would be a bad thing. The yield curve here, we can see that it did drop a little bit over the quarter. And so we see here, this is the current curve. This was last quarter here on the top line. So this was last quarter, this is current, so rates have come down a little bit. Again, there's expectations that the Fed continues to drop rates. Everyone remember that there's not a direct mechanical relationship between the Fed dropping rates and the 10-year bond. The Fed funds rates, right, are the rates that the large banks borrow from one another on a very short basis, overnight or a few days. And so that's not where the mortgage rates are coming from. Mortgage rates are coming from a spread over the 10-year bond typically. And so the 10-year bond is being driven by supply and demand. The lowering of the rates will, in general, be good. But again, the direct connection for like mortgage rates is going to be the spread over the 10-year. Okay, let's look at some quick market factors. Okay, let's look at some of the bonds and stocks over quality and size. So up here on this top line, we can see that the high yield bonds are still in favor over investment grade. So that's a risk on assets still in favor. That makes sense for the quarter when the market's running. When we look at large cap versus small cap, it's predominantly been a large cap market with this line sloping down. But we do see it this quarter, small caps did perform well and they did have a little tick up. So they did have a good quarter like we talked about prior. Growth and value, we see growth continue to perform over value for the quarter. Momentum, again, over value. As you can see, it oscillated a little bit throughout the quarter, but it ended up higher than it started. So again, momentum was in favor for the quarter. When we look at international versus the US, international, again, was falling a little bit behind. It's been strong for the year, but this quarter we can see that the US did end up higher than the international. However, when we look at the valuation, we continue to see that the international, the value advantage there is to the international stocks, and its forward-looking PE is well compared to the S&P 500 is well below a standard deviation point. So again, we still think there's a lot of value in international stocks, and we will continue to want to have those in the portfolios. When we look at market cap weighted versus equal weight, again, we saw that capitalization weight work. That was the S&P 500. The main index that you're most familiar with is what was in favor. The equal weight was not in favor. So what is that market cap versus equal weight? Just for a quick reminder, market cap is where you have 10 stocks, but the majority of those weighting are in a few stocks at the top. An equal weighted index is where each stock has exactly the same weight to the index. So that's why we look at those two, right? It's kind of a weighting that was assigned to certain stocks versus equal weight. And so we like to look at both to understand what the market's doing and where it might be going, and should we be more active or should we be more passive. So again, here what we're looking at are the different sectors. If you see the green line here, this means that the market cap is winning. Okay, if it's in white, then down here you can see that we have equal weighted up here winning, so the green indicates the winner. When we look at the market overall, again, we see that market cap is winning, and for the quarter, over the last 12 weeks, again, market cap has been in favor. So what's the outlook? Last quarter, you'll notice that we were neutral across the board. We put some bulls on the screen this time. We're a little more bullish with U.S. equities, international, emerging market, because the rates are starting to come down. So if that trend continues, that should bode well for stocks. So it made us a little more bullish. Inflation is close to Fed target, so that's good. That's supportive of the markets. You don't want to fight the Fed. A rate cut has already come. A rate cut has come this quarter, and the market is expecting more rate cuts by year end. Interest rates, the yield curve is positively shaped and has steepened. Remember, sometimes when the yield curve inverts after being inverted, that could be a warning of a recession. So we'll still have to watch and see there. Increased opportunities for active management, like we talked about. Again, we like to be able to pick stocks through the noise, and so that is going to continue. The asset allocation is still doing well for those of you that are looking for risk-off strategies. But with all investments, we still need to be patient, right? This isn't a raging bull market. It's not a raging bear market. We're still, 50-50 with data coming in, so we still have to be patient and cautious. But right now, we are a little bit more bullish than we are bearish. This is also starting to be seen in the AAI, so it's the American Association of Individual Investors Sentiment Survey. those readings are becoming more bullish than they have been. And so again, the sentiment is also starting to catch up with the market performance. Fixed income is stable. There's a battle between flight to quality versus inflation versus rate cuts remain. And so we're kind of just neutral on fixed income. Corporate earnings have been resilient, and again, these geopolitical events have been reasonably digested by risk on assets. So what's the market going to do? Well, according to Bloomberg consensus estimates, we've got out of the S&P 500, 54% of the companies are a buy, so 271 out of 503. Holds are 46, 231 out of that 503, and there's no sells. The return potential looks to be about 9.3% over the next 12 months. Of course, that's no guarantee. That could go up 20 and down 20, but based on bottom-up estimates, the analysts are giving that a 9.3% expected return. On the right-hand side, you can see year-end target. It's about 644. It's currently at 6,700, and so there's some evidence that the market could pull back between now and the end of the year. It's had a great year. Typically, when we look at seasonality, the fourth quarter is usually pretty good. November, December, even October are typically have been are good months recently. So we're in a good seasonality position for the market. Okay, so what do? Well, do what we always tell you to do, right? You hold enough cash to make you comfortable. You evaluate the time horizon and other investment policy factors to make sure that your portfolio is positioned right for you for where you are right now. You want to communicate these changes and your objectives and constraints, and then be patient. What do we need to do? We need to listen to you and adjust your portfolio allocations as necessary. We're going to continue to manage cautiously, looking at the data, right? Not emotions. We're going to continue to monitor and adjust, and then we're going to continue to communicate. Remember, as analysts, we got a large team of analysts working on your portfolios, and the three things that we do are we investigate, we analyze, and we communicate. So hopefully we are communicating not too much and not too little for you. Again, on presentations like this, there's a lot of people that I probably went too deep for, and some people I went too shallow for. So we're trying to get it just right for you. If you have other questions, just reach out and we're happy to answer those for you. So with that, I'd like to thank you very much, and we look forward to seeing you next quarter.